They think they're lowering their risk by leaving the banking system and increasing their returns by going into treasuries. That's not the way the world is supposed to work.
In today's video, ARK CEO, CIO, Cathie Wood, weighs in on inventory pileups, liability-driven investing, commodity prices, and why she believes that the Fed is making a mistake as they base policy on lagging economic indicators. Wood discusses fiscal policy, monetary policy, market signals, economic indicators, and innovation.
Fiscal policy. So this week, Janet Yellen, Treasury Secretary, came out and said that she thinks that the government will run out of money to pay bills by June. And so many people thought it would last through August, but apparently tax revenues are not coming in as high as they thought. And so the deadline is now moved from what many people thought could be August, September, to June 1st. So this is all about the debt ceiling debate. And we know there is a big divide between the president's proposed budget and what the House is coming up with. And they do not seem to be talking to one another or with one another. So again, we look at this as unfortunate, but it is short term. We know they're going to raise the debt ceiling. I think they've raised it every year except 2, I believe. And the political stakes are pretty high. We are entering into an election year. We've got politicians throwing their hats into the ring, which makes that ever so real for those who have to vote. So we think they'll figure it out. I don't know if there will be a technical default or not, but they're going to figure it out. The debt ceiling will increase. And the question is, will they come up with a budget at any point in the near future? The one thing I wanted to focus on in terms of fiscal policy and all of the government spending that has been spewing out since the beginning of COVID is that it seems like government spending is beginning to crowd out the private sector. And what I mean by that, this is related to the banking crisis, actually. If you look at what people are doing with their money as they leave banks, they're going into treasury securities for the most part, in money market funds, safety. And it is interesting that they think they're lowering their risk by leaving the banking system and increasing their returns by going into treasuries. That's not the way the world is supposed to work. You usually increase your returns as you're increasing risk. So the incentive to do it, given the bank failures that seem to be occurring regularly nowadays, the sensible thing to do is to go for the higher return and the lower risk. So M2 growth rates are accelerating to the downside. And we've never seen a swing in money supply like this one. We've gone from 27% increase in February of 21 to now minus 4.1%. So that's a 31 percentage point turnaround. And one of the things that puzzles us is that the Fed is not talking about money supply. If you think about the Fed, the makeup of the Fed, I don't think any one of them has been involved in the financial markets. Neil Kashkari at the Minneapolis Fed was at Goldman for a while and PIMCO for a while. But the way I understood his roles, he was more of a relationship builder. I don't think he was watching market signals as far as a day-to-day job. So I understand that they probably don't respect market signals the way we in the market think they should respect them, but they should respect economic signals. And if you look at the basic identity that everyone learns in Macroeconomics 101, it is MV equals PQ. I know I went through this on the last in the know, but I think it's important to repeat and to keep bringing this to people's attention. MV equals PQ. It's an identity. They have to equal. PQ is nominal GDP growth. And it was in the 6 to 7% range on a year-over-year basis in the first quarter. So that's nominal GB. Between ChatGPT and GDP, I'm getting twisted here, but that's nominal GDP growth. So 6 to 7%. On the other side is money. And I just mentioned that in March, money was down 4% on a year-over-year basis. For the quarter, it was probably down closer to 2%. So minus 2% on this side. But we have to get the identity up to what we already know is, let's just say 7%. So if it's minus 2 on this side and this is 7%, we have to fill the hole. And how do we do that? It's with velocity. Velocity is the rate at which money it turns over in the markets. So velocity must have increased roughly 9% in the first quarter. And so it's doing what it usually does after a crisis. It's trying to get back to the actual downtrend that's been in place since 1997. And it didn't get back there yet. And we do not believe it will get back there. The reason is the banking crisis. During a crisis, velocity usually slows down, the rate of increase slows down, flattens out, and actually goes down. During COVID, velocity collapsed. And so we don't think it's going to collapse, but even if it simply flattens out on a year-over-year basis during the next few quarters, money growth is unlikely to turn around given what the Fed policy is doing. And I just mentioned it's accelerating to the downside, exacerbated, of course, by deposits leaving the system. Now, I think the Fed has something like 200 PhD economists. And one would think that Macroeconomics 101 might be a consideration in the policy discussions and in the minutes of the Fed meetings and in the speeches that Chairman Powell and others give. We don't hear it at all. So, but I think market signals are going to force this topic upon the Fed. So let's talk about market signals. The yield curve is still inverted. Now, it's not inverted as much as it was before the crisis. Before the banking crisis, the week before, the yield curve was inverted by 100 basis points. That means that long rates were 1% below short rates. Long is measured by the 10-year Treasury bond yield and short as measured by the 2-year Treasury bond yield. With the banking crisis, actually short rates adjusted more than long rates in terms of flattening out the yield curve a bit. We're down to roughly 48 basis points, so it's been cut in half. But long rates haven't moved much since the crisis, so that adjustment has taken place mostly by short rates. Well, the Fed has just telegraphed that it doesn't want short rates to do that. It wants short rates to go higher, at least at this point in time, and they'll keep an open mind going forward. That is a little bit of a change. And so that's good. So that's one market signal. And typically the yield curve, if it's inverted, is pointing to much lower than expected growth. And actually every time in post-World War II experience that the yield curve has inverted, and it inverted way back in July of last year, the economy has entered a recession. The second market indicator is also in the fixed income markets. So credit default swaps. I'm looking at the banks, money center banks, as well as the regional banks. The money center bank credit default swaps have been moving up. And what are credit default swaps? They are hedges against the risk of bankruptcy. So they're protection, they're insurance policies, and people buy, when the risks are going up, the price of these insurance policies is going up, and that is what is happening now. And it happened for most of last year, as a matter of fact, after a quiet period in 2021. I'm not going to name the banks because I don't want to pick on anyone in particular. But money center banks are a representative one here. If you looked at the price of the credit default swaps pre-COVID, they were in the, let's just say 30 to 50 range. If you looked at them at the peak of the COVID crisis, when we were worried about a depression, they peaked, let's say, in the 175 to 200 range. So that was quite a big increase. But then they settled back down in 2021, back into that, it was more like a 40 to 60 range. And now what we find is they have doubled or tripled from there. So they're not quite up to where they were during the COVID peak, but they're getting there. They're more than halfway there. So that is saying that even the big money center banks, which are the systemically important banks, the SIBs, are seeing this kind of insurance policy taken out. Now, why would that be? Well, first of all, we are seeing a continuation of bank failures, and what's a little troubling about this is that the administration seems to be, I'm not going to say wanting it to happen. I'm sure it doesn't want it to happen. But what the administration is saying is, hey, banks that made bad decisions, shareholders will be wiped out. President Biden said that when he addressed the nation, I think it was on March 13th. And bondholders will be hurt as well. So this is what I mean by, not paying attention to market signals. Well, if you have investors fleeing banks, this is going to cause the bank prices to go down. And that's exactly what's happened. The KRE, which is a regional bank index, in February of 22, the index, so it's a stock price index, this was before the Fed started tightening, it was at 79. And today it's at 38. And it's broken some of the technical supports that I think investors were depending on. At the COVID low, it was 27, and at the 09 low, it was 14. So it's broken down, and it's heading for the COVID low. What is the incentive for investors to move funds into banks when they're seeing deposit outflows which may be accelerating for all we know. We know money growth is coming down at an accelerated rate, and demand deposits are the biggest part of money growth. Fed has just raised rates. That's another incentive to move away from these banks that are somewhat hamstrung in terms of competing with money market funds, because during COVID, they made two mistaken assumptions. And I'm going to, unlike a lot of people, I'm going to say those assumptions were understandable. And I wish that the administration would focus on that instead of making these bank management teams out to be, really stupid and irresponsible almost.